Take it away. All right, Michael, thanks so much for the intro, and Lucille, thanks for having me. We're all aware that we're going through an entrepreneurial renaissance today. In fact, there is a record number, over 40 different startups which have reached $1 billion in valuation. Meanwhile, corporations are struggling more so than ever before with the pressure to innovate. This is one of my favorite graphs if you're tuning in online, where we're showing that the average amount of time that a company spends on the S&P 500 list for the last 60 years has dropped from an average of 60 years to just 15 to 18 years today. And this research was conducted by Richard Foster, a professor at Yale University. And Richard went further. He went so far as to say that this data shows that by 2020, 75% of the companies on the S&P 500 list will be companies that we haven't heard of yet by 2020. So I've worked with employees of thousands of enterprises around the world to help them to be more innovative and to deliver new products to market. And I find that companies have tremendous amounts of resources that they could use to take advantage of this entrepreneurial movement right outside their doors. To give you some data on this, just the top 5 cash-rich companies in the world have 10 times more cash on hand than all the venture capitalists invest in a single year. 10 times more cash than all the venture capitalists invest in a single year. That's not even to mention the brilliant people that are inside your company who are dying for a chance to bring their ideas to life. And so I meet with a new innovation manager almost every week who tells me about the innovation program that they're working on. And I find most often that entrepreneurship, as we're structuring it inside organizations, is an oxymoron. We are giving employees the incentives that don't really match up to the incentives that individuals need to be entrepreneurial and to deliver new products to market. I think the root of this, for me, really comes from the innovator's dilemma, where Clay Christensen explained there's 2 different types of innovation. The first type of innovation is sustaining innovation. And these 2 types are mutually exclusive for the most part. The second type is disruptive. So sustaining innovations are innovations where we are taking our existing products and business units and we're helping them deliver us more revenue. We're innovating on top of what we already have, or we're delivering the same products at a lower cost. These type of innovations are what big companies love, and they're actually what they excel at already. Most big companies are also publicly traded, and the pressure on the short-term basis is so intense that business executives love to see an innovation that can deliver them quick revenue, whereas a disruptive innovation is bringing a completely new product to market that has the potential to change our industry. These products could double or triple our bottom lines, but they take 5 to 10 years to actually reach fruition. And so for me, the root of all the problems with entrepreneurship and innovating inside large organizations comes from the difference between these 2 forms of innovation. And almost every innovation manager I speak to wants to come up with disruptive innovations because they see that that's the opportunity, that's the way that startups are innovating, and that's the opportunity for them that's not being met or targeted. But the pressures internally are directing them to innovate in a sustaining way. And so over the next hour during this presentation, I would like to share with you the specific strategies that you need in order to innovate in a disruptive manner and how these are different from sustaining innovation strategies, as well as how we incentivize the entrepreneurial people inside of our companies to really be successful at what they're doing. And finally, I'll end with the next steps that you need to take to start implementing this approach, because I've learned some very hard lessons in working with many companies to do this. So to get on the same page, let's actually look at the path that successful disruptive innovations follow. So this is a graph called the startup curve. This was created by Paul Graham, the founder of Y Combinator, who has invested in over 900 early-stage startups. He says this is the pattern that all successful startups follow, or as I'll refer to during this presentation, startups also mean disruptive innovations. So before you embark on doing an entrepreneurial venture, Your happiness we see here is on the x-axis, and the y-axis. We time on the x-axis. Your happiness is just average. It's how you are normally before you embark on this journey. And when you decide to take that leap to start something, to start a startup, what happens? We get super excited. Our enthusiasm is through the roof. Almost inevitably, reality sets in, and entrepreneurs enter what we call the trough of sorrow. This is where all the uncertainty lives in starting a venture. It's where, on a daily basis, life isn't that great. It requires a lot of experimentation. It requires pivoting to get through this process. This is where most startups fail. And this is where most corporate innovation projects that are disruptive fail. Very few companies, very few projects actually make it to the point where something starts working, and even fewer make it to the promised land, what we call product market fit. This is where everything starts working and you look like an overnight success. What many of us discount is that all these successful startups spent 2 years in the trough of sorrow before they were an overnight success. And so how do we model this process? What are the strategies and what are the incentives we need for this process to work inside of a large corporation? Well, for those of you who are familiar with Lean Startup, there's really 3 principles that we use in the trough of sorrow. The first is the idea of the minimum viable product. In fact, I said minimum viable products because there's more than one. The minimum viable product is how we expend the least amount of effort in order to learn if what we're building is what customers want. And this whole process is predicated on the idea that most startups fail because they build something that no one wants. Very few of us are building a technology from a science fiction movie. Very few of us are building a cure for cancer. I'm sure there might be maybe 1 or 2 of us out of the 100 people on this webinar. Now, so if that's true, if that we're going to fail because we build the wrong thing, then what we want to do is expend the least amount of resources and effort to learn if what we're building is what customers want. And it doesn't have to be a fully functioning product. In fact, it can just be a landing page, right? You can just build a landing page for the product, send Google ads people to see if they actually click to buy your product. There's so many different tests that we can run to learn about different metrics of a new business opportunity. And it's not going to be what we thought it was going to be. I've done this thousands and thousands of times with entrepreneurs, and our ability to predict how successful a project is going to be is not very good. Now, the second principle is the idea of pivoting. Now, if there's a small chance that we're going to be right about building what customers want, we need to do the minimum viable product. We have to be ready to change our product based on what we learn. In fact, almost every successful startup has pivoted. So Instagram started as a location-based social network. Twitter started as a podcasting site called Odeo. PayPal started as payments on the Palm Pilot. YouTube started as a dating site. And Groupon started as an online petitioning website. All these successful startups started with something they were very passionate about, something they thought was going to work, something that all the market research data showed them was a good business opportunity. Their business plan was flawless, but they went to market and nobody wanted it. They didn't get the response they needed. So they didn't waste their time trying to convince the market and trying to change the market. Instead, they pivoted to deliver what the market wanted. Now, in market research, we are studying how the market exists today. In customer development, in this managerial science for entrepreneurship, we are trying to figure out how the market is going to be tomorrow. And so that is the fundamental difference between market research and customer development, is that as an entrepreneur or an intrapreneur, you're trying to predict the future of the market. And we rely on a special type of customer called early adopters. Early adopters are people that they don't care about a brand name in order to try a product. They are experts in their industry. They feel a higher level of pain than the average customer. And so they're willing to try new things, and they're willing to take risks on new products. And they're going to be able to make up their own mind as to what the best product is. And these are the type of people that you want to target as an entrepreneur. And so these are the 3 principles that we need to get through the truck of star, the minimum viable products, pivots, and early adopters. And together they form a new managerial science, because startups and disruptive innovations are fundamentally searching for something that people want, whereas big companies are in the business of execution. They execute on what has already been developed, that has been proven that people want it. They try to sell more of the same thing to the same customers. And sustaining innovation is much closer to this execution than it is to the searching, which is fundamentally at arms with execution. And this is why that as recent as 2010, we've seen some of the leading business schools starting to teach these principles because they weren't teaching them before. And almost every large company is figuring out how do we educate our employees on these lean startup processes. So today I'm going to go into, as I mentioned, 3 things: the strategy that you need to think about in order to innovate disruptively, the compensation that you need to give these entrepreneurs, and the roadmap for how to sort of change the culture, change the mindset inside your organization. So there's really 5 strategies that I discussed in the book, Lean Enterprise. I'm going to cover the 3 most important here. The first strategy is the idea that innovation is unpredictable. Disruptive innovation is unpredictable. Now, I'm sure many of you haven't seen the Lean Startup process 1,000 times like I have at the workshops, but I can promise you that the people that get it right in the first time, it's not out of any higher level of intelligence or anything other than maybe statistical probability. And most big companies go about innovation how? Well, they host idea competitions. They want to get as many ideas submitted as possible. And then, worst of all, they want experts to predict which ideas are going to be successful. Now, this is great for sustaining innovation. If you're a domain expert, you can predict what small sustaining innovation is going to work because you're a domain expert. But when it comes to disruptive innovation and changing an industry, you can't really predict that. You can't predict how an industry is going to fundamentally change. If you're a domain expert, you're used to the way that things are. And Clay Christensen, the author of The Innovator's Dilemma, said it best when he said that at the time of development, disruptive innovations, historically, did not know the applications. So at the time of development, the people who developed historically these disruptive innovations that we have seen did not know the applications. And he goes further to say that it is impossible to know the applications of disruptive technologies. In a big company, the direction is clear and we know where we're going, whereas when we're searching for a market, you can't predict it ahead of time. You have to experiment. You have to figure out which ways the different pathways go and eliminate a lot of the options to figure out what's going to work. So this is the first principle, the idea that innovation is unpredictable. Now the second principle, second strategy, is that small teams are much more successful than large teams when it comes to disruptive innovation. In fact, 2 co-founders is better than 3 co-founders. And Jeff Bezos has something he calls the 2 pizza rule, that if your team cannot be fed with 2 pizzas, it's too big. Because when it comes to disruptive innovation, it comes to changing direction quickly to figure out what people want. The more people that you have that are able to partake in the decision-making process, the slower that direction change happens. And ultimately, the slower that you get to something that people want. Now, as recently as 2011, News Corp, they created an app called The Daily. I'm sure many of you have heard of this. Now, how did they go about developing The Daily, this innovative iPad app? Well, they invested $25 million and staffed 100 employees on this project. And it doesn't take $25 million to build an iPad app. I'm sure that we know that the Daily was not successful. It had a big marketing launch, and it flamed out shortly after. So News Corp would have been much more successful employing 20 different teams of 5 people and splitting up the capital to experiment with different iPad solutions and letting the best idea bubble to the top and succeed. So the third strategy here is the idea of 1,000 failures to have one success. Now, I showed this graph earlier in the presentation, this graph of the billion-dollar startups. Now, what do you notice if you look all the way to the right of this graph? Well, the most valuable company in this list is Facebook. And if you actually want to see where Facebook stacks up on this graph, the height of our monitors are not big enough to actually see where this would go. It's actually, in this graph alone, Facebook is now actually worth over 200 billion, not 122. But we'd have to make our screen 4 times larger, 4 times higher to see the end of Facebook. And so this is the pattern that most venture capital portfolios follow. In the venture capital business, one investment pays for 9 others. And this is also called the power law of returns, where one company is going to give you the majority of the returns when it comes to disruptive innovation. If you look at Y Combinator, they've made over 900 investments, and the most successful one is Dropbox. In fact, Dropbox is worth more than all the other investments that Y Combinator has made combined. If you look at the second most valuable company, Airbnb, Airbnb is worth more than all the other companies combined. So it's really going to be one big winner that we're looking for when it comes to disruptive innovation. And the way that most companies approach piloting disruptive innovation is how? They say, we're going to make one investment, we're going to fund one project. If that project is successful, then we're going to fund more. There is not a single venture capitalist in the world who would think like that when it comes to generating returns for their limited partners. And yet, almost every company is thinking that way. So if you made a bunch of investments, if you were Y Combinator and you just missed Dropbox, your portfolio would be worth half as much. And so you have to make a certain number of investments in order to just play the game. And the earlier you go, the more investments you need to make. Y Combinator had to make 1,000 investments, whereas a venture capitalist who invests later in the game has to make 10 investments to have a big winner. So those are the 3 strategies, the 3 ways of thinking about disruptive innovation that are fundamentally different from sustaining innovation. We did that innovation is unpredictable, that small teams are more successful, and that you need 1,000 failures to have one success. So we're going to move on to compensation. Now, I think that all of us could agree that Google is a very innovative company, a company that we would all like to aspire to make our company more like. However, when we look at the research and we look at what's happening with Google, they've missed out on many successful breakthrough disruptive innovations. In fact, the founders of Twitter, Instagram, Pinterest, Foursquare, Asana, and Cloudera were all Google employees who found it easier and more profitable to leave the innovative culture that Google has, that supportive environment, and build their companies outside of the corporate walls. And what you also notice is that these are all companies with the exception of Asana and Cloudera, in the social space, an area of critical importance to Google's future direction, right? Google has come up with Google Plus as a result of trying to capitalize on the social movement, but yet the employees inside their own walls would have been a paramount resource if they just empowered them and supported their projects in the right ways. And when we look deeper into corporate America, you'll see that most of today's most successful entrepreneurs spent time in large corporations. All these companies on the above actually came from the companies below. And the average tech entrepreneur has 14 years of work experience before deciding to start an entrepreneurial venture. This is very much unlike the college dropouts that we see in the media all the time. The average tech entrepreneur has 14 years of work experience. And so to understand why these employees are leaving these corporations who are as supportive as Google is, we have to really understand the motivations of these individuals. And one of the biggest misconceptions about entrepreneurs is that they are risk takers. If you look at all the research, there has never been a study that has been able to correlate an appetite for risk-taking with the decision to start an entrepreneurial venture. There was a study done by Harvard where Dr. Tim Butler studied over 27,000 individuals, entrepreneurs and employees, and he found 2 reasons why people are more likely to start an entrepreneurial venture. The first reason is that they had an earlier exposure to entrepreneurship in their life, and that helped them understand it and be more motivated to do it. Now, today, entrepreneurship is everywhere. There's the Social Network movie, and so everyone today has a little bit of exposure to entrepreneurship. The second reason why people decide to start an entrepreneurial venture comes down to the rewards that they value for their work. So when he did the study, he found that employees and entrepreneurs value very different rewards for their work. So for employees, he studied 13 different potential rewards. Employees, the rewards that they value for their work most, number 1 is security, number 2 is recognition. And when it came to entrepreneurs, number 1 is power, number 2 is control. And if you look at where recognition and security show up for entrepreneurs, they showed up dead last, 12th and 13th in the list of the rewards they value. Now, Chris Dixon, in conversation with Kevin Systrom, who is the founder of Instagram, they were talking about why so many entrepreneurial people leave Google when it's such a great company to work for and they're so supportive of creative thinking. And Chris boiled it down to this. He said, ownership is why you stay up all night. It's why you think about this all day, every day. Stock options in a large corporation can never feel like ownership. So for those of you who know the story of Twitter, Biz Stone, one of the founders, actually had $2 million in stock options at Google that he left on the table to go and start Twitter. And he didn't have any money to his name. He actually just paid off $50,000 in debt. But the idea of owning the project that we're working on, that having skin in the game, as we say, that having a real stake in the success of the outcome is what drives many of these entrepreneurs to leave the corporate environments that they're in order to venture out on their own. And I think that there's a lot of resistance inside corporations to accept this idea. And many people ask me, well, is there a way that we can incentivize people without, is there a way that we can help people who don't want equity or don't want any skin in the game to be more successful? And I don't believe so. The reason is because if you read the research on compensation, specifically the book Drive by Dan Pink, he shows that extrinsic rewards, such as a salary, actually lead to poor performance when it comes to highly creative work. So extrinsic rewards are really helpful when the goal is clear and the way to get to the goal is simple. If you're telling me to run a 100-meter dash in a straight direction and you're paying me money to do that, I'm going to be able to do that faster and deliver on it more frequently. Whereas if you're asking me to go through the trough of sorrow, to figure out from weak signals what the right answer is, that extrinsic reward is not going to be very useful. By actually giving people a stake in the outcome, by giving them equity, we're increasing their ability to problem solve. We're making their brain more effective. And we know in the business world that we would never compensate a salesperson with a 100% salary. But yet, we're not giving entrepreneurs, we're not giving these innovators any skin in the game. Whether they're successful or not, they make the same amount at the end of the day. And this is hurting their ability to be successful. Now, in our research, we have looked at tons of different innovation structures over the last 20 years. And we found one innovation structure that is much more successful, and we call this an innovation colony. Just like in the colonial era, the established countries sailed to distant shores in search of an economic advantage to break new ground. And the citizens who embarked were colonists. They gave up some of the amenities and took a risk in order to gain power and control in the new world. And so many different innovation structures are called the same things. And so I'm defining a very specific kind of innovation structure that already exists called an innovation colony. And the key to an innovation colony is three things: giving entrepreneurial people more independence to be successful and to navigate the trough of sorrow. And the three criteria is that these entrepreneurs are given a predefined amount of resources and allowed to allocate those resources however they want. They're allowed to change direction when they deem necessary without being slowed down by approvals. And they're allowed to seek outside expertise and capital. So the core idea here is that when it comes to disruptive innovation, the probability of success is going to be much lower for an internal group that is subject to all the bureaucracy and politics that we have inside a company where we're focused on execution. These bureaucracy and politics are very useful in an execution environment or sustaining innovation environment, but when it comes to being successful in disruptive innovation, we need independent internal groups, or we need to spin off innovations as separate legal entities. So let me talk about some of the case studies. Can anybody tell me where this product was developed? Mike, are you there? Maybe you can tell me, if you can see this, where this product was developed?
Where it was researched and developed, or where it was brought to market?
Okay. All right. So you just kind of spoiled the question there. But yes, it was the Macintosh computer. The technology for it was developed at Xerox. So we know that this is well documented that Steve Jobs went to Xerox PARC and he said, "Hey, you guys aren't doing anything with this graphical user interface of this mouse. Do you mind if I just borrow these innovations?" And now Apple is the world's most valuable company, whereas Xerox is still in the copier business. And this is an endemic problem in innovation labs where people are incentivized to come up with great innovations, but they're not incentivized to bring them to market because, as I mentioned, they make the same at the end of the day, whether they bring it to market or not. Now, what you may not know about Xerox is that there are also two other technologies that Xerox developed in their innovation lab by researchers that they didn't bring to market. The first was Ethernet. Okay, the cables that we use to power the internet were developed at Xerox PARC, and it was a researcher, Bob Metcalf, who asked the executives if he could, just take the technology and start a company with it because they weren't using it. And the executive of the company said, that's fine because Ethernet at the time, it's not core to our competency. So, go ahead and take it. They didn't take any stake in it. And the third is the desktop software that built Adobe. Adobe was also researchers at Xerox who asked their executives, "Hey, you're not letting us develop this software here. Do you mind if we go develop it on our own?" And the Xerox executive said, "Fine, it's not core to our competency. Go ahead and develop it on your own." And so these are three technologies that could have paved Xerox into new industries and led it to be maybe where Apple is today. But they weren't fostering disruptive innovation. They weren't allowing entrepreneurial people to thrive in the organization, just like the mistake that Google has made over the last 10 years. And so, but in response to these failures, there's actually a book written about it by two McKinsey consultants called Fumbling the Future. Now, a lot of people say that it wasn't until this book was written that Xerox really took note of these mistakes and that the executives decided to make changes. And in 1989, they created a venture fund called Xerox Technology Ventures. And unlike many corporate venture funds, so if you look at the corporate venture industry, the venture funds are structured in many different ways, and actually the verbiage used is not really accurate. So Xerox Technology Ventures was much more of an innovation colony following the three principles that I explained, than maybe what you would perceive a corporate venture arm to do. So the way that Xerox Technology Ventures was structured was that they had $30 million in funding, and in 1989, you cannot buy a lot of servers. You cannot fund a lot of the hard costs as you could today with the same amount of money. So $30 million is not very much money at the time when it comes to starting ventures. And this fund was allowed to write a $2 million check without any approval. And they were given access to distribution arms. They were able to make partnerships internally with different business units. But they had a lot of independence to spin off researchers that they thought were talented. And this is another distinction, is that Xerox Technology Ventures was founded to invest in smart researchers inside the company. It was not funded to take IP that was not that was just sitting around and they weren't doing anything with it. It was started to fund innovative researchers. And so what they would do, as I mentioned, is that they would spin off these researchers as new legal companies. Xerox would get 80%, which is a huge amount, and the researchers would get just 20%. They would also partner with other venture capitalists to fund these businesses and bring in an outside CEO. The researchers who left Xerox had to sign a contract that said they would not get their job back if the company failed. So these researchers were taking some risk in order to embark on what they thought was much more upside, 20% versus 0% to bring these products to market. Now, 7 years later, the value, the $30 million that Xerox Technology Ventures had, the companies that they funded in market cap were worth equal to Xerox itself after just 7 years, right? So 7 years, remember, a disruptive innovation takes 5 to 10 years to accrue substantial value. So after 7 years, though, they were able to turn $30 million into the market equivalent of Xerox itself. Like, this is incredible. And 5 years later, a total of 12 years after, those companies were worth 10 times more than Xerox. So after 12 years. Now, this is pretty incredible, and there's tons of research that you can read on Xerox Technology Ventures, and I highly recommend it for any innovation program manager to do more research on it. But how do we know that it really worked? Well, the interesting thing is that we actually have a control group for what happened, because at the same time that XTV was given $30 million, Xerox funded internal innovations for more than $35 million, $5 million more. And those innovations all failed. They all failed when it came to going to market in the face of internal bureaucracy, politics, and lack of the same incentives that XTV was offering their employees. So we actually had a control group for this experiment. And if you look across the spin-out industry, you can actually find many examples of companies, of projects that reach unfathomable success by being given independence. There's lots of literature on this. And so if you do the research, you'll find the same conclusions that we've come to. Now, I want to give one more example. Now, many companies are coming with corporate accelerators, and I consider some corporate accelerators to follow the innovation colony model. And there's one from Microsoft that I want to focus on. Now, the corporate accelerator is given $2 million in funding. Now, $2 million today is probably the equivalent of $30 million, 25 years ago, when it comes to the servers and the technology that you can deploy with it, because the cost of starting a startup is so much smaller today than it was 25 years ago. And this accelerator is given $2 million in funding, and they can make $20K investments in startups. Okay, and they would actually source majority of the companies from outside of the company, because there's a lot of deal flow outside that you can tap into. But they would also source some companies from internal employees. And so these entities, again, are new legal companies, and Microsoft would keep 7%, much smaller than 80%. whereas the researchers and the geeks would keep 93%. Pretty awesome opportunity. And they would source from thousands of different companies and pick the top 10 to work with. So they follow that rule of having a large volume of innovation projects in order to pick the top 10, and hopefully one of these is going to be the big winner. And 3 months after funding these companies, that $2 million actually helped those companies raise $20 million in total. So after just 3 months. Not only that, but there was actually this really interesting company called Metrics Hub. And Metrics Hub was a team of former Microsoft employees. They were actually in the desktop publishing business unit, and they left, started Metrics Hub, and in 3 months they got to market, they had customers, and they had a term sheet from outside venture capitalists. Now, whenever an innovation project, this is the real value of spinning out these entities and allowing them to raise outside capital. Whenever you have outside validation, it makes it much easier to get momentum internally, because when we see that professional investor is going to put a number to a company, and keep in mind the amount of companies that outside investors see is much greater than you could ever see inside an innovation department inside a single company. So there's much more of an efficient market in the venture capital community than there is inside any given company. It's going to help pick the winners for us and make that decision-making process easier. And for Metrics Hub, Microsoft liked what they were doing so much that 3 months after they left the company, they offered to buy them back for the same amount of money as the valuation of the term sheet. For the entrepreneurs, that's a great outcome. They agreed to do it right away. And for Microsoft, this product now serves as part of the back end for an $11 billion business. Right? For just single millions perhaps, they were able to acquire technology that could serve as the back end for $11 billion business. Now, remember, many of the projects probably eventually will fail from the accelerator, but that's okay because this one success pays for all the rest. And there's also examples of companies like Cisco who do the same process of spinning out disruptive technologies early on to eventually later spin them back in to be an important part of a business unit or to form a new business unit. And so that was compensation, and that's the innovation colony approach, to give these disruptive technologies independence so that they can be successful and accrue some value to us as an enterprise. Now, I want to go over the roadmap for how to sort of change the internal culture to be receptive to these strategies and to be receptive to the compensation. Okay? Oftentimes, I think the advice I'm giving is seen as being perhaps difficult to implement, but it's actually not that difficult. What you really need to create inside your company is momentum and a common mindset towards these practices, and you will be successful. Now, the first thing is always going to come down to training and sharing the right information with the people in your company and getting them to understand it. And we find that a 2-day training is really the minimum that employees should go through, because the way that you operate inside a company is at such ends with how to do disruptive innovation that you can't have people sit in a lecture and just talk about how to do it. You need to have them go through a real-world experience where they're trying to bring a new idea to market. They're going out and interviewing customers, and they're finding that many of their assumptions about the market are wrong. And by doing this with many companies, we've found that while doing this with entrepreneurs, when they find out that their assumptions are wrong, they may get depressed. Inside a big company, when they find out that their assumptions are wrong, they get very angry because they've been sitting in meetings for 2 weeks, maybe months, brainstorming on a project that within a day they could go out using customer development and prove there's no market demand for. And so it's kind of a shocker, and a good shocker, that is going to change the mindset and give people more understanding about innovation and how at arms it is with the status quo inside a company. We found that you really have to take 30% of the director, VP, and managerial level through a training, a 2-day experience to get the momentum that you need inside of a company to start making things happen. Too often people will just train the champions inside their company, and they don't extend that training to the rest of the company and have those champions train other individuals through an experience. They focus on just regurgitating the information, which isn't going to give people that understanding of the real difference between this type of innovation and what we do on a day-to-day basis. It's impossible to predict what it's going to feel like to have your assumptions blown into a million pieces and to find out something that you are very passionate about is actually not what customers want. That cannot be explained period. You have to go through a process to understand it. Now, so the first step is always training. The second step is establishing an accelerator inside your company that follows the Innovation Colony prescription, where you are giving internal projects more dependence, or you're funding other companies in the early stage space that are in line with your thesis for how the market is changing, allowing these companies to raise outside capital, to work with your executives, and to help them be more successful. And this all comes together in an innovation funnel where, as we mentioned before, you need 1,000 failures to have one success. You need a lot of deal flow in order to actually source the great opportunities. Any venture capitalist knows this. And you're creating a funnel of validated ideas inside the company by, first of all, training them on how to use minimum viable products, pivots, target early adopters, and you're funneling them into a structure that follows the Innovation Colony prescription, funding them, and eventually acquiring them. And this is how the systematic innovation inside your company can really empower you to take advantage of the entrepreneurial renaissance outside your doors. You have the smart people inside your company. You have the resources. All you need to do is change the mindset inside your company. So thank you all so much, and I'd love to take some questions.
All right. So a couple people have asked questions in the chat already, and I encourage people to ask more questions. One of the questions people had, Trevor, is where to get ideas. Like, how do you identify if something really could be a disruptive innovation, if it's not just going to increment one step, increment 2 or 3? Like, what would you do to gauge whether your idea can really be a disruptive innovation?
Yeah. So by nature, most of the things that a business unit leader is going to want are going to be sustaining innovations, because, as I mentioned, they're judged on a quarterly basis, and they're looking for quick revenue streams. They're not looking for a 5-year, 10-year potential. So disruptive innovation is really something that goes against what your company wants. So, to know if it's disruptive, it's something that's new and that's different, that could change the industry, but that, could really cannibalize internally your cash cows. So that's how you really identify something that could lead you down to a path that could, in the long run, double or triple the bottom line of your corporation or be a significant new business unit, is that it's going to meet internal resistance. And that's why clearly we need a new structure for it.
And as a follow-up question to that from one of the attendees, let's say that you want to implement all of the ideas of the Innovation Colony, but you are looking for incremental innovations. Is there a way to make that work if you're not trying to be disruptive, or would you recommend a different approach to innovating the enterprise using incremental innovations?
Yeah. I think that one of the biggest trends in incremental innovation falls back on lean user experience and design thinking and user experience in general. You have to keep in mind that most companies are already good at developing sustaining innovations. And so I think that if you want to create sustaining innovations, one of the things that's working for many companies today is having a more user-oriented design mindset. And I mean, we can see this just by how different many of the consumer products that we use are versus some of the enterprise software that exists. But you know, if your job is just going to sustaining innovation, I think first of all, do not apply any of the things that I have just mentioned to you, because sustaining innovation and disruptive innovation are mutually exclusive. You need to focus on one or the other. It needs to be clear inside your company which one you're focusing on. And don't try to innovate disruptively. Don't try to be like a startup if you just need to come up with sustaining innovations. Try to apply some of the new processes that can reduce costs, that can create more customer value, but don't try to innovate like a startup if you're just trying to come up with incremental and sustaining innovations.
So, and then somebody asked from the audience, like, how would they kickstart this type of innovation within their organization? Their organization is in a bank. They asked how to kickstart it in a bank in particular, but I also think that the attendees might be interested in how to start this conversation within their organization in general, how to kickstart it. So maybe if you answer if there's any unique situations that might occur within a bank, but also how to do it in general.
Yeah. So you have to build momentum inside a company. You have to build bottom-up momentum. And you can find case studies of every industry of spin-outs being successful. In fact, I believe it was Charles Schwab who, at the onset of online trading, created a new entity for online trading because it was so disruptive to the way they were doing things. And they eventually shut down the old company in order to, and the online trading company became the new company. As we know, online trading has paved a clear pathway ahead versus what Charles Schwab was doing before. And you have to build momentum, and that really comes from training, from experiential training inside a company, and also just being clear that people in your company want to be innovative. One thing that I recommend to every innovation manager that I talk with is to use the lean techniques to validate that people actually want to be innovative inside their company. We take it for granted that the employees in our company have ideas that they want to bring to market. I'm sure that in every company I've met a handful of people that do fit that description, but is there really enough people for us to get to a critical mass where my aspirations as an innovation manager are going to come to fruition? As I mentioned, 30% of the VPs, directors, and managers is really a tipping point for that momentum. And all you have to do is create your own MVP, create your own landing page to see if you can attract enough people to sacrifice 2 days of their work to learn this process. If your company, if you put up a landing page and you can't get enough people just to sign up to attend a training, it's going to be very hard for you to create an accelerator if you don't already have one, and to start bringing new products to market. So you need to test the riskiest assumption inside your own company at the very beginning to see which approaches are going to work. Great.
And then there was a question from one attendee about hiring you to come in and help them kickstart innovation. Maybe this would be a good time to give a pitch about our Lean Enterprise organization, because we're not training people. We're not training people inside the organization to how to innovate, but we are training the innovators to train their organization. So Trevor, maybe you could tell people a little bit about Lean Enterprise organization.
Yeah, Mike, why don't you do it? Why don't you tell everybody?
All right. So if you guys check out leanenterprise.co, we actually have a group of innovators. We're working with 40 different companies right now, all Fortune companies. and providing unconferences in their cities where they can come and meet with other enterprise innovators. So essentially, if you're in a company that has more than 1,000 employees and you are tasked with an innovation role, this group is mostly directors, vice presidents, senior vice presidents. We organize meetings for them and an email listserv so they can spin out ideas and help each other. So it's kind of part conference, part support group for these people. But we don't sell any consulting services within the organization. This is strictly innovators helping innovators, that type of thing. And there's a page to sign up if you're interested on leanenterprise.co. Did I leave anything out, Trevor?
Yeah, I think that meeting with other innovation managers is going to be absolutely key for you to figuring out what's going to be right for your company, because we're really at the infancy of this movement, and it's a complex subject. If you are expecting to walk away from this presentation knowing exactly what you should do, that's not what's happening here. You need to take some of the information here and meet with other innovation managers in your same position to hash out some of these really complex subjects. And that's what the Lean Enterprise Group is all about.
Trevor, you mentioned something interesting on the Xerox case study, where you said that the people that took this role in their external innovation lab had to sign an agreement that said that they would not be rehired by Xerox if their products failed. Did you find out what happened to any of those people? Like, were there any that failed where they couldn't get back into Xerox, or were they able to continue their careers? I'm just curious how it worked out for them.
Yeah, I don't have any data about that, but to be honest with you, I really don't think that would have been an issue. I mean, today having an entrepreneurial line on your resume is a great thing. To show that you have experience in that world and that you've worked on something innovative, even if you've completely failed, it's going to better prepare you as an individual in so many different ways. I mean, I think that a lot of people are concerned with that. But the opportunity to turn, if you're really serious about an idea that you have, and you are, the next Biz Stone or the next Kevin Systrom who's almost ready to leave your company to pursue it, then you're already ready to leave your company. It's not going to be a big thing. And so you want to find people who are ready to be innovative, who are ready to start something. And I think that was a great test to filter out the people who are really serious and going to spend, are going to be up all night thinking about their project and do whatever it takes to make it successful, from those who are just kicking the tires and aren't as serious. So, I just love that. I love the Xerox story so much,
Me too. Well, with that, it looks like we're out of time. If there's any questions, you can tweet at me. I'm at Michael Gold, and Trevor's at TO. And I'd like to pass it back to Vasil to wrap things up.
Yeah, thank you so much, guys. Thank you, Trevor. Thank you, Mike, for being a part of it. Before we wrap up, I actually have one burning question for Trevor. Maybe if you can answer in a minute or so. If we can go back to that slide when we talked about entrepreneurs versus employees. I'm trying to find it very quickly. Okay, here we go. So I know that we talked a lot about innovation within enterprise, but if we flip it a little bit around slightly, as we have a lot of founders on the call, what would be, Trevor, your advice for a founder hiring his first employees? Would you, in order to sustain innovation culture, would you like them to be in the mindset of entrepreneur, or would you, on the other hand, you also need them to execute? So would you also hire employees, some of the employees that actually are not in that entrepreneurial mindset? What would be your advice for a founder?
Yeah, I mean, you have to hire employees in the beginning stage who are more interested in the power over their own future and the control over their own work. If you hire someone, and this is a spectrum, keep in mind, it's not an absolute here. everybody knows, I think, that has started startups before, knows that you need to hire people who are going to value the equity that you give them, and they're going to value that small team environment where, there's a chance that that company could fail, but that they see that the skills that they're gaining in that environment and the potential upside is well worth it to them. So you don't want to pick the people who are on the extreme end, because those people are going to start their own companies. But you want to have people who are are going to get more value out of those rewards, because in a startup you don't offer security and you're not really offering recognition. You don't have a brand name that people know about. And so it's really, the funny thing is, it's all you can offer in a startup. Whereas inside a big company, you can choose to offer one or the other.
Gotcha. All right, great. Thank you so much. It makes a lot of sense. And I highly encourage everyone who enjoyed this webinar to also take a look at the book, The Lean Enterprise, if you want to dig a little bit deeper into the presentation today. And also, as Mike mentioned, there would be a very cool event happening in February in San Francisco. I will send some more information in regards to that, so you guys can sign up. We have a lot of attendees from San Francisco today. Finally, a quick shout out to our sponsor of today's webinar. And thank you so much for joining us today. Thank you, Trevor. Thank you, Mike. We'll be sending the recording of this webinar via follow-up email. Thanks, everyone, for joining, and have a great day.